Navigator Global Investments is an ASX-listed company which invests in alternative asset managers around the world. This means it buys stakes in the businesses of these asset managers and receives a split in the earnings of them. The alternative asset managers charge management fees of anywhere from 1 to 3% per annum, plus a performance fee for their sophisticated investment strategies, which are used by institutional investors all over the world, including Australia's Future Fund. Navigator is broadening its range of managers away from hedge funds to include property and private equity as well. This business caught my eye and at the time of recording was trading on a price to earnings ratio of just 6.7 times. So I reached out to CEO Stephen Darke and we got straight into the business of Navigator Global Investments. The stock code is NGI. I hope you enjoy. Stephen, tell me about the business of Navigator. What does Navigator do? How do you make money?
Well, thanks for having me, Mitchell. Navigator is the only stock on the ASX that's really focused purely on alternative asset management. And we own stakes alongside the founders of 12 firms globally. And each of those firms is sort of a leader in their particular field of investing. And we make money by investing as strategic partners of them. And we really get paid dividends alongside those founders and when they're successful as being investors. And those firms manage just over $80 billion US across all the strategies. And they're really global firms with a global reach covering many alternative asset classes.
So Navigator receives as an owner of these alternate asset managers, you receive revenues from their management fees and from their performance fees, essentially.
That's right. And also to the extent we have money invested in their underlying strategies, then we can get, realized and unrealized gains from those investments. But you are right. The main source comes from the fee revenue that they generate, because when managers really successfully manage money on behalf of investors, they are paid either a base fee or indeed if they perform, and it's usually linked to it, is always linked to their performance, they're paid a performance fee. So we really share in the base and performance fee revenues across those 12 underlying asset managers.
And when you say alternatives, what type of actual asset, because it's alternatives is a very broad basket. What type of asset classes are these companies investing in? What type of strategies are they undertaking? Who's their clients? Who's giving them the money?
Yeah, well, you're quite right. I think if you asked 10 people their definition of alternatives, I think you would get 10 different definitions, Mitchell. But the way I think about it's pretty easy. Alternatives are sort of not cash, buying shares or buying bonds. They are effectively an asset class that is designed to produce different investment returns than what you typically get from traditional asset managers. And they can encompass areas like private equity and private credit and real estate, all of which we have within our portfolio. We have managers that manage those strategies. It also encompasses subsectors like infrastructure, which is a very large alternative, subsector, and hedge funds, of which actually play a very important part in Navigator's business. We have ownership stakes in a number of the world's leading hedge fund managers that have really managed money over multiple decades. There are aspects of alternatives that we don't look at. Art, cryptocurrency, they would be, I think, viewed by some as alternatives, but we've viewed them as more speculative and less about investment management. So I would think about a lot of these asset classes that produce a return that really comes from a different source than traditional asset management, and they really should form part of every investor's portfolio.
When we break down the Navigator different revenue streams, what percentage kind of comes from those hedge funds versus those other alternative assets that you got?
It's around about half from the sort of hedge fund or more liquid alternatives business, perhaps a bit more than that. And the rest comes from private market style businesses or longer locked up capital. So it's been more historically on the hedge fund front. However, we have been express in our strategic pivot for the last couple of years to really focus on private markets managers globally. Earlier this year, we acquired a minority stake in a leading healthcare private equity manager out of the US called 1315 Capital, and we are really focused on adding asset managers that operate longer locked up closed end funds.
Why is that? Why was that strategic tilt undertaken?
Well, look, I think, we're a listed stock, and the listed market, I believe, sort of undervalues performance fee revenues. And I also think they undervalue, hedge fund strategies that have a higher, what would you sort of redemption profile. I don't think they give the credit for hedge fund managers for having actually far stickier AUM or more locked up AUM. And so from our perspective, we want to do two things. One, we actually want to diversify the portfolio and get not just hedge fund businesses, but also a number of other alternative businesses, a lot of subsectors and geographies that we don't include. But also, we want to make sure that the capital underlying, if it's locked up for a longer period of time, it does attract a better public market multiple if you have more committed capital. So that's been a focus. But we would only do that if the underlying firms, and I'm sure we'll get into this later, really satisfy all the diligence criteria and all the things that we're looking for in an alternatives investment manager. And very few of them do.
Right. Yeah, you are quite right. We'll definitely be getting into that. Stephen, so do a number of your investments have that lock-in period, so that, minimum 5 years, 10 years plus? And what, say, looking at the hedge fund specifically, what are the fee structures like in there?
So on the locked up capital, it's really important, and this is a broad observation, that when any of your listeners are investing in investment products, whether it's more traditional or otherwise, that they pay a lot of attention to the liquidity profile of the fund and make sure that the terms of redemption and when they can get their capital out actually matches the underlying asset. There is a concern of mine that some investors don't, pay too much attention to their ability to access, money at a particular time. Perhaps they think it's a bit more liquid than it truly is. In the case of the Navigator portfolio, we have a range of different liquidity structures, and each of our managers operate different strategies in different vehicles. Some are open-ended, some are closed-ended. So it's hard to broadly have a generalization. But I would say for the managers that are investing in assets that are hard to sell, like real estate assets or a private equity position in a healthcare company, they typically have 8 to 10 year locked up funds, potentially with extensions that can go beyond that at an investor consent. Now, on the hedge fund side, typically, although it is changing, it could be as low as monthly or quarterly liquidity with notice, although you are really seeing some what's called soft lockups, where investors may really need to be in strategies for at least 12 months, and then after that, there's a bit more liquidity. So you're seeing a number of different shifts and trends in the way that structures are being offered to investors, which is one of the big thematics that's happening around the world in alternatives at the moment.
And what type of fees do these hedge funds charge?
So, look, the first thing I would say is, quite significant. And the only way you're able to charge that sort of fee yield is if you are consistently producing returns across cycles. So to answer your question, across the Navigator portfolio on the NGI strategic side, we have an average base fee of 1.2% across our portfolio. I would say that across any asset manager in Australia is the highest average fee yield that any manager would be receiving. And that is because we are 100% alternatives. However, there are some managers in our portfolio, Mitchell, that charge a 3% base fee, and others that charge 2%. Usually you don't see a hedge fund that actually is doing all the hard work to generate absolute returns across any market cycles, charging a fee of below 1%. And even that sort of fee would be probably for an institutional based account. Now, on the performance fees, it's typically 20 over 0. We can talk about over the 0, but effectively to the extent the asset manager generated an absolute return, then 20% of that return, of that gross return after base fees, would go to that asset manager. But they are expected for that fee yield to actually produce those returns regardless of what the broader markets are doing. So if we take the environment right now, very volatile, a lot of geopolitical risk going on, people will invest with leading hedge funds and alternatives managers because they expect those managers to produce returns right now. In markets that are going north, when you're buying the Mag 7, everybody's making money, or the ETFs are going up, then these sorts of alternative products could still be generating that return, but they'll be doing it on a lot less risk. In markets like now, their role is to be generating return when the markets are not necessarily generating return. That is really where perhaps the reference to alternatives come from. For a diversified portfolio, you want to have investments that do both of those or are driven by both of those sorts of dynamics. So yeah, for hedge funds, I would say typically 22 and 20 over zero, but it does range, both up and down on the performance and base fee side.
Can you paint the picture for myself and our listeners of what these hedge funds are actually doing? What assets are they investing in? What kind of strategies are they doing to generate these absolute returns that institutional investors are happy to? And when we talk institutional investors, we're talking things like, industry like super funds and family offices and very sophisticated investors. What are they doing where these sophisticated investors are happy to be paying 2% plus a 20% performance fee? What are they bringing to the table? What does it look like?
Yeah. Well, the first thing, and look, that's a great question. Just the opening remark, I would say, when you mentioned superannuation funds, and we don't want to go down this rabbit hole, was not the point of the podcast, but in Australia, there is a regulation called RG97 that means that Australian super funds are sort of ranked by the fees that they are effectively paying. And so, many Australian super funds are therefore precluded from investing in high fee paying alternatives.
I hope I haven't opened up a rabbit hole here.
No, you haven't. But, for your listeners who have got superannuation funds, unfortunately, a lot of them are not able to be, even if they wish to be, can actually invest in these products or choose to invest in these products because of the fee yield, which is quite strange, isn't it? Because if you think about it, you and I should be quite happy receiving 12% return on our money, even if the fee was 3%, versus getting a lower return on your money if the fee was lower. So it's a bit counterintuitive. I will give the listeners some words of comfort, though. The Future Fund is not subject to that, and they have curated over a period of 15 years a hedge fund portfolio that I believe represents 15% or so of their AUM, which is really our AUM as a country, into an extremely high quality pedigree portfolio of hedge funds, and that is going to protect Australians' capital for years to come. But to answer your question, yes, you are right. Institutions generally, I would say endowments and foundations, family offices, public and private pensions in the States that aren't subject to that slightly strange fee-based criteria, are looking for this. Now, why are they looking for this? They're looking for it to be able to diversify and hedge their portfolio in times exactly like happening in 24, 25, where you're seeing a lot of volatility. So that's why they do it. It's typically not an enormous part of the portfolio because most of it still is in traditional asset management, bonds, stocks, and cash. But it is increasingly representing a percentage of the portfolio, to the point where some investors, US endowments and foundations, have as much as 40 to 50% of their portfolio into what you would call alternatives. And that has been across all investor classes increasing over time. And we can come back actually, but at the moment, there is a pretty enormous thematic towards Australian high net worth individuals and wealth platforms, which this might be quite relevant to your audience, are seeking more and more alternatives, strategies to generate yields and returns different from their ASX portfolio. So, we've recently seen quite a large amount of demand from our manager here, Longreach, who are talking to Crestone, Coda and Macquarie and seeing a lot of demand for their alternatives products. But I haven't answered your question, and I will do it. What are they doing? So everyone's doing a different strategy. That's what, and by the way, they don't want other people to know what they're doing. So this is very proprietary. They have typically, by the way, not everyone can do this. There's only a small amount of the population that has been trained, that has been working potentially in the proprietary parts of investment banks or in private equity firms. It's also typically out of New York and London. There's a relatively small group of people that are in this business. And therefore, there is actually a war on talent, by the way, between the big hedge funds for the best talent out there, because it's a limited supply of people that can do it. Let's take one of the more simple strategies, which would be equity long short. So equity long short is a hedge fund strategy where a manager would go long and buy a particular stock, but then they would also look to hedge that by going short or thinking that another stock similar would be going down. So the two of them together would effectively provide a hedged position, and they're betting that one business, let's just say Boeing, would do a lot better than Airbus. So they might go long Boeing, we believe Boeing, and short Airbus. They're hedged, but in fact, they really believe that over time, the Boeing company is going to outperform the Airbus company, and that's what they make. So they are not doing something very simple. They have to find a company that they believe in that strategy will probably reduce or have a lower stock price. That is it's a harder thing to do to successfully over market cycles, go long and short equity positions. And that's what deserves the additional fee if indeed they are successfully able to do that. So we have a great equity long short strategy within our portfolio. North Rock runs about $5 billion US, and they were up 14% last year after fees on very low volatility. And they're also up this year, even though the market's been very challenging for equities, particularly in US. That's what you pay these type of managers for, and they should make that return in all climates. Whereas let's just take Nvidia, for example, is a normal stock. You can buy that, and it's been a fantastic run over the last 5 years in Nvidia. But until just recently, since mid-April, but the first 4 months of this year, the stock was down up 40%, perhaps not quite as much as that. So hedge funds will try and hedge that risk so that you're only down 1 or 2% or up 1 or 2%, rather than driving that massive volatility up and down, which for most people, they can't stomach that sort of volatility. So hedge funds sort of provide, if they're good, that extra layer of protection. But that's just one example. There are so many different examples of running alternative strategies, but hopefully that's helpful for your viewers.
Yeah, no, that's great. And so it's really about them finding that risk adjusted return, and for every unit of risk they're taking, how much return are they able to supply to their investors. Now, when you look across your suite of managers and the revenues that they're generating, their management fees and their performance fees, how closely correlated are they with each other? Do you get major periods of significant performance fees where they're all coming in at the one time, or are they, is one offsetting the other when their performance isn't quite there?
Yeah. Well, that's an excellent question. And I don't want to, bore the viewers with sort of discussions around correlation and diversification, but in our annual earnings and half annual earnings, last one was done on the 19th of February. In the appendix, we do include a slide, and that slide really shows the lack of correlation and the diversification across all of our managers that run liquid strategies. It's very important because you want to be in times that are going really well to have a portfolio that on a diversified basis is making money, and equally on the other side, if times are not so good, generally in the markets, that the strategies are uncorrelated to each other. And that analysis has shown us, and we look at it regularly, that in fact that not only are the strategies uncorrelated to the markets, they're uncorrelated to each other. So when we're looking at additional investments, we do pay attention to the impact of adding that new strategy to see whether it's correlated with our existing strategies. Now, typically though, with true hedge funds, and I would say a lot of people say that they are investing with hedge funds, or that they may run a hedge fund, but a true hedge fund is coming from the ability of individuals and teams of portfolio managers to create their own investment returns from what they bring to the table, their investment expertise. If that's the case, then actually a lot of different teams that operate differently and make different decisions are actually all are creating returns that are different from each other. That's not the same, for example, if you were to invest in 2 or 3 different long-only Australian equities managers, you might find they operate very, very similarly because they're holding the same stocks. They're all holding CBA, or very much they're weighted to try and match the index. our managers are actually focusing on creating their own or using their own investment expertise to generate new ideas. And typically they're very different from firm to firm. And we pay a lot of attention to that point.
Stephen, can you walk us through your selection process? So your job as the CEO of the business is to, put these managers in place to come along and say, right, we actually want to buy a bit of you guys. We can help you out. You can help us out. We want to be an owner of this business. Your background, can you walk us through your background and what makes you, good at what you do, and what then you go out and look for in terms of people and investment opportunity when you're putting capital to work for NGI shareholders?
Yeah. Well, there's a lot in that, Mitchell. Let me start a little bit by saying the first thing, which is we have a great small team at Navigator, and in particular, the CIO, a gentleman by the name of Ross Zachary, is based in New York. And Ross has really spent, just like I have, most of our sort of working lives in alternatives. Mine since 2006. Ross is almost the same. He's working at JP Morgan and Citi, really for the head of alternatives at both of those places. Ross's role really, other than really managing the portfolio of NGI's investments and relationships, is originating new asset managers. And I work, closely with Ross, of course, and we do exactly what you say. We're looking to approach managers here in Australia or in the US, and they often approach us looking for strategic partnerships. And we'll come back to why they might do that, because I think that is a really interesting rationale as to why they need a partner. In terms of my background, I was at Macquarie for 23 years. And in 2005 and 6, the leadership team of the asset management group, the investment bank at that time, wanted to learn more about hedge funds and private markets and alternatives. And so I moved to the US and spent 12 years in New York from 06 to 18, really learning all about hedge funds and private markets firms. And I probably, we did this fund that seeded or established these strategies. So Navigator doesn't do that. We actually buy minority stakes in established firms. But at Macquarie, we were seeding managers from zero. They didn't have a track record, and we would, almost like venture capital, we would give them their first money, and we would take an equity stake and we would help them grow from zero with our money all the way up to being a successful asset management firm, hopefully. So during the investment period of that fund, I probably saw 700 investment management teams, typically 2 or 3 people initially, and we would look, and we ended up seeding 11 firms. And out of those 11 firms, 4 were quite successful, which I'm very proud of. But 6 or 7 of them, we had to actually close down over the GFC. It was a brutal time in investment markets, 2008-9. And either because we couldn't fundraise for those particular managers, or because their investments just failed to deal with the stresses of the GFC on the markets, those managers, we ceased supporting and funding those. And that was a very sad time and a very difficult time to close down some of these businesses. But it was sort of that pain point in the markets for the last 20 years where now I really like to find out what people were doing over 08, 09. Were they managing money? How were they managing money? How did they deal with risk? It's that sort of acid test of the last 20 years to understand really how good they truly are. One of the challenges with Australian managers is that I don't believe a lot of them have been through that period of stress and tension, which has allowed people to truly determine whether they underwrite credit risk or equity risk effectively. They haven't done it. But over in the US, it was just that time where the Dow was dropping 500 points a day. And it was just the time where you could determine whether a strategy was truly going to be sustainable across markets. So when I returned from the US in 18, and then I left Macquarie in 2022, became the CEO of Navigator in late 2023, it was an opportunity to take all those skills in seeding and in the US and alternatives in a role in Sydney, which I actually did not anticipate would come up and really help educate the market and also talk to the investors, which I've been doing all morning, about the topics that we're talking about today and why a portfolio of alternatives firms is going to generate growing earnings over the short to medium to longer term. So I'll stop there, and maybe there's a follow-up question, but I would like to come back to your entree, which was like, why would a firm partner with us and other managers? Because I think that's a really interesting dynamic, but I'm happy to take that where
let's go there now. Let's do that one.
So picture this, a successful team has started a firm. They've usually spent 10 or 12 years at Goldman Sachs or Blackstone or Ares. They decide they want to start their own firm. They go out, they start their own firm. It's successful. Another 10 years passes. So they're typically 20 to 30 years into their career. They've spent their entire 20 or 30 years focused on a specific investment philosophy, style. They have an edge, and we look for that edge when we're identifying managers. They could be anywhere from, say, $1 billion to $5 billion of assets under management, very profitable. But they see an opportunity in the market, for example, where they want to raise another $1 billion of capital. Perhaps it's an adjacent strategy or another strategy of what they want to do. They have invested all their own personal capital into the business over those first couple of vintages, and they have two options. Either they don't sell a part of their firm to a firm like Navigator and they continue being successful, or they do sell a bit of a firm and take the capital that we give them to be successful quicker and to accelerate the growth of their business. And they will do that equation. And typically, if they don't capture that opportunity that they've perceived, they'll lose that opportunity to somebody else, or it might go away with the passage of time. And so typically when we provide Navigator or the shareholders' capital to new firms, we're acquiring a 20 or 25% share in the entire business alongside them. They own the remainder of the capital, which is what we like, alignment of interest, skin in the game. And then they take that capital, and generally a lot of it will be invested as primary capital into the business to grow the platform, start the new product, build their distribution team. Otherwise, think about warehousing assets. We like that dynamic, and we retain their independence. We're not buying the firm. We want them to be committed over the 5 to 10 year period and longer to actually take the firm from 1 to 5 billion to 10 billion to 20 billion. So 2 or 3 of the larger firms in Navigator's portfolio run $20 billion, one of them. The other one runs $16 billion. These are incredible platform businesses with 400, 500 people in it. But when the capital was first given to them as growth capital, they weren't that big. And so we also offer strategic advice. A lot of us have been doing this for a long period of time. My predecessor, who is the founder of Lighthouse, which is our largest business, still works in the business. I speak to Sean a few times a week. Probably one of the leading hedge fund people in the world, based out of West Palm Beach, Florida. Sean has been doing this for a long period of time, 30 years in alternatives around hedge fund businesses. So between us and our largest shareholder, Blue Owl, we provide the expertise of growing businesses from 0 to 20 billion to all of the firms that join our portfolio. So they usually come to us because they want growth capital and strategic advice, and we're not trying to buy them. We're trying to invest alongside them as growth equity. So I hope that's helpful.
There's investing and then there's business. What indicates to you that these good investors are going to also operate a good business?
Well, that was a particular challenge when we were seeding and incubating managers at Macquarie, because we couldn't look to see what they've done because it was a new business. So we didn't, for example, Mitchell, know how making money would change them psychologically, which I believe is a very important point to diligence. How is making money going to change people's view on what they want to do with their lives, how they feel about investing? The great thing about Navigator's business model, and we sort of loosely, it's referred to in the world as GP staking, buying a minority stake in a general partner, is that the business is already established. So we have a chance, as I said, it's usually 10 years developed. We can see what they've done. For example, we can see how they've shared the equity amongst their team. We can see how they allocate their performance fees amongst their team. We can see how they've thought about succession planning. We can see how they've built their distribution team. Have they done it well? We can see who's left the firm and who's stayed. What is their key person retention risk? If we see orange flags on them, we don't invest. There's all these ingredients you need in order to be a successful asset manager. We get a chance to do our due diligence, which is very comprehensive, over 4 to 6 months typically, using third parties and our own work, background checks, talking to clients, talking to staff, to make sure that they have all these ingredients. So there are a lot of things you can see, whether they've worked together for multiple decades. If, for example, partners have left at the partner level and there's one individual who's dominating the business, that's not a business that we believe may be sustainable, or the risks are too high. So we could be talking for hours, but it's those sorts of attributes that you could actually visibly see and understand whether have been well managed. Because your point's right. I have come across a number of asset managers who are excellent at trading stocks, who are excellent at trading strategies. But when it comes to being a leader and growing a business, often those skill sets are just mutually exclusive, and they're better off running a sleeve of money for Ken Griffin at Citadel, because then they'll just get the money, they invest the money, and they don't have to worry about the other aspects of growing the business. But we're investing in people that have done and have grown a business that has all of that. It's a far more valuable business.
I'm curious, when something doesn't go right amongst one of the managers that you are part owner in, what does it look like? Do you guys have to step in, help out, provide advice? Walk us through a scenario that hasn't played out.
Yeah. So there are big advantages about the minority staking model, where you're allowing the founders to control their own destiny and make decisions that are related to the firm, and the focus is on alignment of interest and making sure that their compensation is aligned with mine, but allowing them to grow their business. When we're diligencing a firm, we pay a lot of attention to the things that might go wrong and making sure that we have protections around those things, either contractually or commercially in the documents and otherwise. But that doesn't mean that even if you do that it's going to play out the way that you mean. In our monitoring of the portfolio then, which happens on a monthly and quarterly basis, our questioning and our updates and the reports are all around seeking to understand any increasing risk around that. What might go wrong in a scenario that might go wrong is that a key person may leave the business, right? That, I think, is probably the most important thing. In that situation, often they would be leaving a lot of money on the table. So this typically does not happen, especially if they have equity in the firm and they've founded the firm, but it can happen. It can happen due to, perhaps they haven't performed a particular strategy well. So in situations like that, let me give an example. We had co-CIOs we had two founders of the business. They promoted two co-CIOs. One of the co-CIOs didn't work that well, and they left the business. The important advice to the founders is exactly what happened, which was ensuring that when they are starting to think about succession, rather than relying it all on one person, you do the co-CIO and make sure that you're diversifying the risk and thinking about it, and then watching how those two individuals are dealing with that leadership succession and making sure you don't have all your eggs in one basket. So in many ways, on key person risk, which I think is a big risk, it's about ensuring that it's all about the team and it's not about taking sort of rock star risk or taking risk around one individual. So it's around putting in risk, mitigation. Generally, though, as a minority stake, you don't have the ability to step in unless there's been like a major problem. You leave that, and you should leave that to the founder and the principal of the firm to be able to manage, because they understand the situation the best. But between Blue Owl and us, we are there to provide guidance on the best approach, what we've seen before, how to deal with it. And in some cases, we've really provided that active dialogue. For Navigator shareholders, that risk is further mitigated by the fact that we have 12 firms and thousands of people that actually work across those underlying firms.
So who's Blue Owl and what do they do in the relationship with Navigator?
Yeah. So we are about an $800 million market cap firm. Blue Owl hold economically about 52% of our stock, very large shareholder. Why do they do that? And who are they? Maybe I'll start with the second question. Blue Owl actually are a $260 billion alternatives firm based out of the US. They've actually just set up more of a presence here that operates separately from Navigator, but they think of like a Blackstone or an Ares or a KKR. They are in the leading alternatives firms globally, listed on the NYSE in the States. They have a number of key business areas. One of them is called GP staking. And that Navigator, as a portfolio company, sits in one of Blue Owl's fund investments. In fact, the first one that they ever launched. And the Blue Owl team in that particular division came out of Lehman Brothers, and they were the first team to really pioneer the concept of owning a minority stake in an alternatives firm. They've now done in that particular division over 60 transactions. The world's biggest alternative firms, many of them are owned, have a minority stake owned by Blue Owl. And so Blue Owl provides the expertise both on the board via a gentleman by the name of Mark Pillemer, who sits on the Navigator board, as well as strategically via commercial discussions with them on a weekly and bi-weekly basis. They actually provide a pipeline of opportunities to us alongside our own origination efforts that Ross and I have of investment managers that are too small for Blue Owl's main funds, but are the perfect size for Navigator shareholders and for our portfolio. So we invest between 25 and 150 million US, broadly speaking, into new investment opportunities. And so when they see transactions that fit that sizing that they like, then they're effectively referred to Ross and I for a diligence and to see if we like the transactions. They also, and this is really important, they also provide access to all the Navigator managers to their business services platform. This platform is world leading. It's about 60 people. This platform provides, think of it like providing all the expertise to an asset manager that they would need other than what the manager does well, which is investing. They provide capital introductions to new investors. They provide advice around succession planning. They provide human resources, recruitment of key individuals. They provide M&A advice, taxation advice, AI, ESG, all the aspects of growing an alternatives firm that perhaps a manager wouldn't have access to unless they partner with the Blue Owl or Navigator is available to them free of charge. So my managers, 12 of them, all have the ability to call up the business services platform of Blue Owl and seek, as well as me and Ross and Sean, and seek guidance on any aspect of their business to grow it. So for example, one of the key areas is, how do we build a distribution capability effectively? Do you know someone that could join our firm? How do we get in front of new limited partners? There is a trend at the moment towards open-end funds and evergreen funds. Blue Owl and Navigator know the technology around creating and generating and the fees that are applicable to evergreen funds. And we provide that sort of intel and IP to our managers if they're thinking about that sort of product. So it's the access to the platform and it's the sourcing that the NGI really gets, which is, it really is a competitive advantage, frankly.
Looking at your business, I'd imagine a lot of people in the local, in the Australian market would come to you guys and go, rightio, well, you're a version of Pinnacle, but for hedge funds. Does that happen? And what's your response to that? Because I'm listening to this and I'm thinking it's quite different.
So you're right on both counts. People do approach us with that similar lens, and you're right on the second point. We are different. So let me explain. Look, Ian and his team and Pinnacle have done just such a fantastic job with that platform. Whether it's the distribution capability, which really I think is a global leading distribution capability, and where they're trading in terms of the multiples also, we believe, last time I looked at it, is the highest actually of any manager of its type in the world. And that is because of how great a job they've done. Ian really, and his team, even though they've been beginning to focus more, overseas and more recently, as well as in alternatives more recently, we are 100% alternatives. And it's not so much on the hedge fund side, even though I understand why you mentioned it, it's all alternative asset management, and so we have cut our teeth, as you could tell by my background and Sean's background and Ross's background, only in alternatives. I personally believe And the numbers are showing that, I think it was Bain and Co. that reported a survey that shows in 5 or 6 years, over half of the revenues of the whole asset management industry are going to come from alternatives because of the high fees and the attraction of what it provides. And the highest growth is coming from the alternative sector and also passive ETFs, but that's not a specialization that we have. And so, Pinnacle have built this great centralized distribution team, and that's available for a lot of traditional managers and alternative managers to access. Navigator's view and the view of Blue Owl is that for alternative firms that are already established, the best way to create value for those firms is to help them have their own distribution footprint within the actual firm. So the 12 firms that we have all have their own separate sales teams that are captive and focused just on raising money for Marble or raising money for Invictus or raising money for Waterfall. One of our businesses has 30 people in that team, and they're one of our larger businesses, and our smaller businesses may have 1 or 2. And in our view, to create the biggest enterprise value around an asset management firm, you have everything in the same box. Now, that's not saying that Pinnacle's wrong, far from it. In fact, if you're starting up as an asset manager, how good would it be to access Andrew Chambers and his team on the distribution side? But our managers really are after building that capability internally and scaling it where they can really have it captive. So I would say it's just 2 different models. And some managers really are looking for one model and help on the distribution, which they'll have to pay for. Other managers are like, we don't need that, but can you help us with strategically, give us some growth capital and help us grow as a firm, but we want to do it ourselves. And so I think there is some overlap sometimes, but you can get very different managers attracted to the 2 models. We are far less well known. And it is true that we are only looking at alternatives. So many of Pinnacle's managers, even if we were involved, we wouldn't have looked at because of their strategies versus what we're really after. But no, what a great business, and how good is it that Australia's got a number of these multi-boutique / GP staking firms that are actually established and listed on the Australian Stock Exchange. I would say that's no accident, by the way. Just so I get a lot of questions about why aren't we listed in America? Because we report in US dollars, and all but 1 or 2 of my firms are actually based in the US for various reasons we can come to. The answer is that in the US at the moment, we would be subject to the Investment Companies Act if we were over there. So it would just be not a very friendly regime, if at all possible, for us to be listed on the US exchanges. The Australian ASX provides a more flexible listing regime, which is why you see, I think, one of the reasons why you see some of these models listed in Australia.
Have you ever sold a stake? And do you ever consider that as part of the business model exit strategies?
It's a great question, because it goes to the heart of why you would partner with a firm like a Navigator. And there's about 6 or 7 firms that we see as competitors globally. None of them in Australia, but there are around. Think of it from your perspective, Mitchell. Just say you had an asset management business and you were after a partner. You don't want a situation where in 5 years that partner is going to want to sell like a private equity fund and just get out of you and try and make a multiple and exit. You want someone who is going to be possibly a perpetual, or permanent partner for you to grow you over, many, many decades. This isn't an asset like a pipeline that's bought and sold on a constant basis. This is a people business. So the listed capital structure of Navigator provides that permanent capital basis of which to be a great partner. There are other ways to do it, but being listed means that we never need to sell or realize our underlying stakes. That doesn't mean that realization events don't happen. But also I do want to be very, very clear, that sort of liquidity event or realization event is driven by what our partners want. So, for example, if you're the 2 founders of a firm that you're 30 years in, it's $20 billion, you've got a large team, what's typically going to happen is that Navigator, are not going to want to, most likely, want to sell out of their equity stake in that firm. And if we did, the principals may not want to sell it. They'd probably want to buy it themselves back again at that point. What typically happens, and the answer is it hasn't happened at Navigator yet, but there are cases globally where it has. would be that a BlackRock would come along to some of my managers and, Navigator's managers and then say to the two principals, not to me, I'd like to buy your business. And it's up to those two principals because they own 75, 80% of the equity. That's their decision. What would though happen? First of all, because it's their decision, it would be in their best interests. And because we've aligned interests with them, it would be in our best interests. And we have very strong documentation, what's called tag and drag rights, where we would effectively sell our stake with those principals. But that's a decision that is really for them. And you know what? That's where we're different from typical PE, because in a people business and asset management business, it really is their businesses, and you're just making sure that you're providing support for them and aligning yourself appropriately. So no, there's not a situation where I would run a process to sell a stake in a particular firm. But you've seen BlackRock recently buy a business of which Blue Owl had a stake in. They bought HPS, a leading credit business, got a Sydney presence here, and they bought that for a very high multiple because BlackRock wanted to be in private credit. And they also bought Global Infrastructure Partners. And so you do see situations where the big guys may come along and offer quite a significant check for a manager that sits in Navigator's portfolio or otherwise. But it's not something that's part of our core business model that we go out and have in our strategy documents because we're a permanent partner. But if it happens, I would have a capital allocation challenge. And we would look at our pipeline and what we have to invest in versus what our best capital management strategy was. And I think investors in the Australian market would probably wake up to just how valuable the managers that sit in Navigator's portfolio. But it's not typically something that we would control or direct. And the answer to your question is that no, since I've been on board and even prior, there has not been a realization event. I would say in the coming years, it's likely that we would see something.
What is the market missing about Navigator, in your opinion? Because we're sitting here and on this other screen over here, I do have Navigator up on, of course, the oracle of all information, Google. It's telling me a PE of just over 4 at the moment. That's cheap. Right?
Yeah.
That's Google. So
I don't think that P is right, but nevertheless, let's call it 7 or 8. It's still cheap.
Yeah, it's still cheap. It's still cheap. I was looking somewhere else the other day, it was 6, etc. Regardless of what we're talking about. I know you were on the Forager podcast not too long ago, and I know Steve Johnson.
Yep.
He likes to find cheap, unloved businesses.
Yep.
The fact that he was talking to you tells me that he considers it cheap and unloved. What is the market missing? Why are we sitting here at that PE?
Yeah, well, look, it's the critical question. It's the question that I spent a lot of time thinking about. I would I'll give you a couple of answers and then we can dig into any or not. So as early as a couple of years ago, this business did not look like this. It had one manager. It didn't have 12. That manager was called Lighthouse, and Sean was the CEO, and it was one hedge fund platform business. This is in 2021, which was pre-COVID, and COVID sort of was, for all of us, was sort of years that molded together. Then in 2021, 6 stakes were acquired from Blue Owl by Navigator, and that's what started to transform this business into a portfolio of alternatives. But no one was looking at the stock in 2021 or 22 or 23. In late 23, when I was appointed as an Australian-based CEO, which I think the board, putting me aside, I think the board made the right decision having an Australian-based CEO because no one was talking domestically and locally to the Australian market. We're covered by Barrenjoey and Ord Minnett and MST and Macquarie on the sell side, which I think is great. And we have a great institutional shareholding following, but because they're investors that understand the catalysts and what we're looking to unlock. But there was no one with full market engagement here. And so I think it's really been quite a recent pivot of the business. And it was only January of last year that we effectively restructured the balance sheet to get rid of what was a significant liability and amount we are owed to Blue Owl for those 6 stakes. So it's only been cleaned up as a cleaner balance sheet for just over 12 months. I would say that we've been working hard on cleaning up the simplicity of the narrative, and our earnings. We just upgraded earnings 3 weeks ago, informed the market of an EBITDA of 106 to 110 million US dollars, which is more than Pinnacle makes. Mitchell, it's just that we're trading on such a poorer PE. So I think it's been recency, recent structural, lack of market engagement until relatively early. But there are some other things. And one of the other things, is that we make our money from alternative firms that have high fee yields and don't necessarily need a lot of flows to come into the business. That is not the same as Platinum and Magellan and a lot of the Perpetual and a lot of the other managers that have historically been Australian asset management centric. Their share prices have gone up and down, and mine does as well, on net flows or outflows. That is not, in my view, the right metric. Navigator doesn't buy AUM, we buy cash flows. We're looking to really effectively value a stream of future cash flows that we believe are valuable. Nicholas Moore and Macquarie taught me that. Blue Owl knows that. They're private equity managers. So we won't, just because our AUM doesn't go up by another $1 billion of really low paying fees, we're looking to add AUM that's high yielding and high quality that's going to stick for a long period of time. And that's what each of our managers do. I think the market's looking at flows far too more than it should be, and we're being viewed like one of the other managers. And frankly, that's on me, Mitchell. I need to do more of this and the education and expressing, and you'll see some of that at full year results, where we're looking at different ways to describe why we differentiate. I'll tell your audience right now that we're having an Investor Day. It'll be, this is the first time I sort of said it publicly, it's not a market moving event, but probably on the 12th or 13th of November, we're going to host an Investor Day. Blue Owl's going to be in town. Ross will be here, and we're going to have a day where we're going to talk about those key features of Navigator that we believe are a bit misunderstood by the market and what's going in the portfolio. So I'm looking forward to that. We started to kick it off, the arranging of it this week. So I really think flows are really, really important. The other thing I would say, and then I'll pause and let you follow up with any questions, but our performance fee mechanics, we talked about it a lot earlier, they're not the same as the way that other long-only managers work, because ours are over zero. To your point, the hurdle's zero. So we get performance fees the minute our managers generate absolute return, and they're significant performance fees, as we talked about. Other managers, if you're a long-only manager, are benchmarked against the MSCI Australia or the ASX 300. If they're below that index, which a lot of long-only managers, it's very hard to beat the index, then they are under and they don't make a performance fee. Our managers make fees once they're over the hurdle. In other words, they're benchmark unaware. I do not think that the market understands the power and resilience of benchmark unaware performance fees and why it's going to consistently be generated. For the last 3 years, we've averaged 94 US million of performance fee revenue across our firm, and it's between 20 and 50 basis points of my AUM. That is a pretty consistent range. And when you look forward, obviously I don't make projections, but with a diversified portfolio that's uncorrelated, you'd expect to see that. And so there isn't another manager like that, and I need to do a better job of describing why a multiple should be attributed to that cash flow stream. Because at the moment, based on what you just said and based on what I looked at every day, that's not being attributed.
Fast forward 10 years, and we'll look to wrap up shortly, but let's fast forward 10 years' time, Stephen. What does Navigator look like?
Well, we have we've sort of been glide pathing the market that we would be able to do 1 to 2 transactions self-funded, because we are, that EBITDA number I gave you, which is, in Australian dollars, 160, 170 Aussie, is almost, it's a proxy for our cash flow. So we have that money available to reinvest in key managers globally. And so we've told the market that the right sort of way to think about our inorganic growth is 1 to 2 deals a year. And so if you think about that, we are currently with 12 asset managers. We don't have an infrastructure manager. We don't have what's called a secondaries manager, which is probably, now's not the time. We'll do a follow-up podcast on secondaries. We don't have really a large Asian exposure, managers that are investing out of the Asian region. And you and I were just talking before we went live about the, relatively new and increased interest in Japan and India and the flow of money that's going to those jurisdictions. We really don't have a European manager other than an excellent hedge fund manager called CFM that's Europe's best hedge fund manager, I think by far, really, with the 20 billion of assets out of Paris. So, having, for example, a distressed credit manager based in Europe to look at those opportunities would be a great thing to add. So there's all these, pockets of strategies and geographies that are not yet reflected, even though very happy with where we diversified, there's more to be done. So if you want to fast forward 5-10 years, there's also no scale cap to our business, really, because they all operate independently. We can add 2 a year every year for a period of time. So I would like to be a portfolio of 35 managers, all, none of them that cannibalize each other, but all with strategies that are further diversifying the portfolio with an EBITDA that could be twice, 3, 4 times where we are right now, and far more resilient with, all these key firms. And so our vision is to be the top alternatives manager on the ASX and a real partner to firms globally as a partner to help them grow. And so that's the vision that we have. And it'd be great to be able to say, hopefully it doesn't take 10 years, but it'd be grateful to be able to say that we've achieved that.
Excellent. Stephen, this has actually been, I'm just thinking about it then, this has actually been a little bit of an un-Rask-like kind of podcast. We just got straight into the business and just went for it. But usually we're a little bit softer. So I'm going to now jump back to 2 questions we always ask our guests, our first-time guests especially. If you could go back and tell a younger Stephen something about life, business, investing, what would it be?
Well, I'm telling my 21-year-old and my 19-year-old and my 16-year-old sort of some of this now, so I think it's sort of live. Are they mini Stephen Darkes? Well, they're taller and they're better looking. But I will tell you, be patient. Life's long. Be committed. Invest early, because the power, I don't know which, famous investor said it, but the power of compounding is that 7th wonder of the world. I'm sure you've heard that in your podcast.
That was Einstein.
Yeah, well, there we go. Well, I should have probably known that. I sort of didn't do well at physics. I was more economics. But no, I will tell you that invest early, think about the longer term. Don't be concerned about taking risk, but be careful how you take risk. Be committed in your relationships, in your investing, but also seize the day. Keep your investing long-term, but make sure you enjoy whatever you do. And I certainly at Macquarie, I enjoyed so much about what we'd learned there from the leaders back in the early 2000s. So find a firm and find an employer and find a boss that you can learn from, a mentor that can teach you things like innovation and flexibility. And find somewhere where you can travel too. Ultimately, I think what you learn, it's a bit cliche, but, what I learned in New York and even a bit of time in London about different cultures, but also the way they invest. I mean, their capital markets are 15 years in front of Australia. So in my business, it's not the same for everyone. In finance, the place to be and cut your teeth on everything was New York. The opportunity to go there, travel, enjoy life, but also make some money and learn the business. And then you can take what you've learned into the next role, making sure that each door you're opening doesn't close too many other doors. I think these are the sorts of lessons that I like to pass on to my kids and to the viewers. The best thing I ever did at school was debating. I have tried to convince my 3 kids to do debating.
Do they still do it at schools?
Huh?
I presume they still do it.
They do. They do. But my oldest son told me, but Dad, that's Friday night. That's social suicide. So I was unsuccessful in getting any of my 3 children to do debating. But I will tell you that if you think about what that gives you and how you think about public speaking and, arguments and thinking on your feet and being able to present, I just think that's such an important skill to have learned. I just was spectacularly unsuccessful in passing it on.
It does not surprise me, sitting down here talking with you for quite a while now, that debating was something that you did at high school.
That's what my wife says. Yeah.
Now, finally, a question that I always ask: me and you are going out to lunch. The out of office is on. We're not coming back. Where are we going? What are we eating? And what are we drinking?
Well, we'd have to get on a plane for starters. So
absolute
I don't know how long your out of office is on for.
It's a long time.
But we would be getting on a plane. We would be going to New York. We would be going to Madison Avenue, 60th Madison. There is a restaurant called Avra, which in my view is the best Mediterranean food in the world, certainly outside Greece, I would think. Not that I'm I'm not an expert. And we would be having octopus and whitefish and a tequila on the rocks.
I don't think I've ever had that type of that meal before, but I'll be willing to give it a go. Tequila on the rocks. Oh,
well, let's be clear. That would be how we would end. I definitely think a glass of white wine while we're having the whitefish, but you'd end with a tequila on the rocks, and then we might need to get in a taxi.
I like it. I like your style. All right, Stephen, I really appreciated you joining us today, mate, taking us through the business of Navigator. It is a way that if people are looking at alternatives and are looking at like alternative managers or alternative funds themselves to slot into their portfolio as part of their asset classes, Navigator could be a way where you could actually slot in for the same weighting exposure, multiple or currently 12 different asset managers where you're getting those revenues, that cash flow from these asset management businesses. So it could be an interesting way for an individual investor to actually play in that alternative asset manager space and plug it into their portfolio. So, Stephen, really appreciate you taking the time. I'll see you in New York.
Look forward to it. Let's book the flights. Thanks for having me, Mitchell. Thanks, Rask. Bye.
Cheers, mate.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.